All right, today we're diving into a really interesting company, Yamatane Corporation. If you're into shareholder returns, you're going to want to pay attention. They've got this amazing history of increasing their dividends, and we're going to unpack exactly how they do it and what they've got planned. So let's get right into it. So let me ask you this. As an investor, what's the holy grail? It's finding a company that doesn't just pay a dividend, but grows that dividend year after year, right? Well, that's exactly what we're going to explore today, using Yamatane as our case study. Okay, let's not beat around the bush. Here's the number that's got everyone talking, 125 yen per share. That's the dividend Yamatane is planning for the fiscal year ending March 2026. And get this isn't some pie-in-the-sky guess. It's a solid commitment, a real signal of their confidence. So a number like that doesn't just come out of nowhere, does it? It's part of a much bigger story. Let's kick things off in Section 1 and really dig into this history of growing dividends. Just take a look at this chart. It really says it all. You can see the steady climb, right? From 56 yen to 65 yen, then a nice jump to 105, but then, wow, look at that planned leap to 125 yen. This isn't just steady, predictable growth. The growth itself is speeding up. And for an investor, that's an incredibly powerful thing to see. I mean, just to really hammer home how big that jump is, think about it. They're going from 65 yen to a planned 105 yen for the 2025 fiscal year. That's a 40 yen increase in one go. A company doesn't make a move like that unless they want to send a crystal clear message, we care about our shareholders. Okay, so the big question on everyone's mind has to be, how? How can they afford these massive dividend hikes? Where is all this cash coming from? Well, the answer is pretty cool. It comes from four distinct but powerful business engines that are just humming along. First up, you've got their logistics and foodstuffs companies. These are really the bedrock of the business, the OG pillars. We're talking about everything from warehousing and shipping to being a major player in the rice and food service industries. So what's fueling this dividend fire? A huge piece of the puzzle is the food business, which has just been on an absolute tear. Sales are up more than 45%, which is great, but the operating profit? Get ready for this. It's up 269%, just incredible. And it's not magic. They were smart about passing on higher rice prices, and they're seeing the full-year benefits from their subsidiary, Shokokai. Rounding out the portfolio are their other two engines. You've got the real estate company, which is like a steady, high-profit anchor for them. And then there's their information company, which handles specialized IT services. When you put all four of these together, you get this really well-balanced, super solid business model. All right, so that's what's powering the machine right now. But as investors, we're always looking ahead, right? We want to know what's next. And that brings us to their roadmap for the future, a plan they're calling Yamatane 2028. And this isn't some vague mission statement. They've put real numbers on the board. They're aiming for 88 billion yen in sales and 4.7 billion in operating profit by March 2028. But here's the number that I think investors should really focus on. That return on equity, the ROE target. They're aiming for 6.5% or higher, which tells you they're serious about using their capital efficiently. Now, to hit those ambitious targets, they know they have to evolve. So they're actually restructuring the whole company. They're moving away from the old, slow divisional system to something they call an in-house company model. It's all about making decisions faster, giving teams more authority, and this is key, finding those amazing synergies between their different businesses. Think food meets logistics. That's where the magic can happen. Okay, we've talked about the four business engines, but Yamatane is holding an ace up its sleeve, a huge one. It's a long-term growth catalyst so big, it really needs its own chapter. We're talking about the Echujima Development Project. Take a look at this. This map shows a massive piece of land they own. We're talking nearly 33,000 square meters, smack dab on the Sumida River. And the location? It's insane, just 4 minutes from Tokyo Station. This isn't just some random plot of land. This is a potential gold mine, a truly game-changing asset right in the heart of one of the world's biggest cities. This is a classic example of what's called a CRE strategy, which stands for corporate real estate. Basically, it means they're not just sitting on this valuable land like a dragon on a hoard of gold. No, they have a real, active plan to develop it to unlock the maximum possible value for the company and, of course, for its shareholders. And this isn't just a dream. they've got a detailed timeline. We'll see the grand vision announced this year, partners chosen in 2026, and they'll break ground in 2029. Now, yes, the big profits from this are still about a decade out, starting around 2034. But for a long-term investor, seeing this roadmap makes it feel very real. The wheels are already turning on this massive project. So, that brings us right back to where we started. We've seen the solid businesses they have today. We've seen the incredible, almost unbelievable potential they have for the future. So now, let's tie it all together and look at exactly how Yamatane makes sure all of this value gets back to you, the shareholder. One of the key ways they're doing this is by adopting a metric called DOE, or Dividend on Equity. Now, this might sound a little technical, but the idea is simple and powerful. It ties the dividend they pay to their overall net worth, their equity, not just the profits from one single year. What does that mean for you? It means more stable, more predictable dividends. It smooths out the bumps, and that is music to a long-term investor's ears. And they're not shy about it. They put it right there in their official policy. This quote you're seeing, it's not just fluff, it's a promise. They're telling the world, we are using DOE as our North Star to guide us toward continuous, stable dividends. So, here's the new policy boiled down. They're targeting a DOE of 3%. They're promising a total return ratio, that's dividends plus stock buybacks, of 70 to 80%. That is huge. They're also giving themselves the flexibility to buy back their own shares. And on top of it all, they're flat out saying they aim to continuously increase dividends. It's an incredibly shareholder-friendly policy. So let's just recap. You've got a rock-solid business foundation. You have a crystal-clear, massive growth project for the future, and you have a shareholder return policy that is about as friendly as it gets. It all leads to one final question, doesn't it? If you're looking for a company to invest in for the long haul, what more could you possibly ask for?